Hello everyone, this is Mark with Semantics Research with your daily report. So today we had a very choppy session before the FOMC on the ES, and as the statement was released, we did have a nice dump before we had a huge rally, and that is a result of a lot of people selling their puts today, which is typical as a lot of puts are expiring this Friday. We have $3.4 trillion worth of options, and a majority of that is consisting of puts. And the fact that the Powell did not upset the expectations gives us a chance to rally into Friday. Perhaps when we see people stop selling these puts, we could see a nice dump in the market as covering rallies have no proper market support, and this is moving up on relatively low volume. You have to remember, even though that we are long-term bearish, it is not proper practice to short at these levels, because at this point the market has priced in 75 basis points, hence why we sold off on Monday and the bond market had adjusted earlier in the week. Yes, we can go down lower in the longer term, but we can't be shorting when the market has already adjusted to expectations, as it is already priced in. The fact that we did not go higher than 75 basis points is quite a sigh of relief for the markets at this current time. Do note that this is the first time we have raised 75 basis points since 1994. We are seeing VIX being crushed today due to an event volatility being wrecked, due to the Fed not doing anything unexpected, which destroy put values and allows market to rise. We are seeing controlled demolition of the markets due to this put buying, and a lot of these hedges in the market that is expiring on Friday will probably see some profit taking in the puts, while most of the contracts will be likely rolled down to lower strike prices and farther out dates, so it is less delta associated with them. This will lower the floor for the market in this case. If we take a look at oil, crude oil did have a pullback today, but that is not really significant in the grand scheme of things. Brent oil continues to hold high, which much less impact to its price, and I don't see the likelihood of oil coming down anytime soon, as this commodities pricing is out of control. The EIA reported crude oil inventories build of 2 million barrels for the week, compared to last week, which was also 2 million barrels. Gas inventories dropped 700,000 barrels last week, which is compared to an 800,000 decline the previous week. Retail fuel prices remain at record highs with a national average of $5 per gallon, and refineries are running at 93.7%, which is higher than usual capacity compared to 94.2% prior. There are also fears of a bad hurricane season that could affect fuel prices by causing refinery closures along the Gulf, and refineries continue to struggle with the effects of the pandemic and cannot ramp up production quickly enough as they in the face of rising demand. The fuel market is projected to remain high for a few years at 418.7 million barrels. U.S. crude oil inventories are about 14% below the 5-year average for this time of year. Motor gasoline inventories are also down 11% below the 5-year average, and distillate is also 23% lower. It appears that higher prices in oil does not seem to have any significant impact on demand, and as talks of the Defense Production Act comes into light, I highly doubt this will have a significant impact on oil. It will likely take talks with Iran, Venezuela, and Saudi Arabia to truly impact supply, and whether or not this would truly happen is rather uncertain, so I would not count on it. Gasoline demand continues to rise with no slowdown as we recover from the pandemic shutdowns. With extremely low consumer sentiment, crashing market assets, and tumbling savings rates, it's not a surprise that the May retail sales disappointed with a 0.3% plunge compared to a 0.1% expected rise and a downwardly revised 0.7 month-over-month rise in April. Keep a note, this is the first negative print since December 2021. Auto sales dropped 3.5% as expected, as it is a discretionary purchase, while the spending at gas stations are up 4% due to higher inflation. Looking at the 10-year TIPS yield, it is basically saying that traders are thinking Treasury yields are higher than the average annualized expected inflation rate over the next 10 years. So people are expecting inflation to come down long term, and we will have it under control at the current moment. Whether or not this will happen is a bit uncertain because this is what they are thinking at the current moment with the data available, but it will probably change as we adjust to new information as they adjust their predictions. We may be seeing a new systemic change, so if we continue to decouple from globalization due to uncertainty in reopenings and other conflicts, as well as that affects infrastructure planning, and commodities staying high can make longer-term inflation settle at higher rates. Probably will be lower than what it is right now, but it can still be elevated. I am personally thinking maybe 5 to 6%. This is just one angle, of course, because there are other factors that affect this, and not just inflation, but also economic growth. So looking at TIPS, it's just mainly inflation expectations. So it is quite important to look at the bonds as well, as it tells you the expectations of GDP growth and inflation combined. So you have to look at both for pricing bonds, and also you should look at the country's default risk or credit default spreads. The basic concept of a bond is that you're giving a loan to the government and they're paying you back interest at a fixed rate. The yield is adjusted to the price and the coupon. And the bond price goes down when the yield goes up. People seem to be buying into the idea that the Fed thinks PC inflation will come down based off their forecast, and it seems like we were in line with what the market was expecting in terms of rates, and believe that it wasn't worse. The revisions to the Fed forecast was in line as well, and the market is not expecting a systemic change, however, and thinks that the Fed will adjust. We may be seeing that inflation will be structurally higher and settles higher, which will then change people's expectations. And when that gets baked in, it will likely result in higher yields and a stronger dollar. Now, going into the CPI is calculated by the Consumer Expenditure Survey, and that is where they call people on how much they're spending over a period of a few weeks. And there is a headline and a core number to this, and the core number is the same number except for energy and food, because core is more indicative of the future, and oil prices are quite too volatile, so you have to discount oil from the core, and generally the headline number is too noisy for most models. Oil prices are still a major factor, though, and it will not go away anytime soon, since the current administration has terrible policy with dealing with energy, and no one is going to invest in higher production with the current administration, as they do not want to get burned. So there is a situation where the Fed has to keep interest rates high because of oil, and that is really bad for the economy. And I think there is a long way to go to deal with oil in terms of the upside. And I find it quite silly that the Fed does not expect much impact on the unemployment rate with aggressive rate hike cycle. The Fed is saying that they don't see a rise in the terminal rates, which is not what the market wants to hear, as the market was pricing in a terminal rate of 3.95%. The Fed told us they expected to see a terminal rate for this year of 3.4% and 3.8% next year. So the market was a bit more hawkish than what the Fed was actually saying. And going into the economic projections, there's no FOMC member that projects the Fed funds below 3.3% by the year end, and they expect the Fed funds rate to be 3.4 in 2022, 3.8% in 2023, 3.4% in 2024, and 2.5 in the longer run. And going into 2024, the Fed expects 40 basis points of rate cuts and 90 basis points of rate cuts beyond. And the balance sheet reduction will proceed as planned, as well as inflation to be around 5.2% at 2022 end, with core PCE being at 4.3 at the end of the year, and the Fed funds rate being at 3.4. Also, the balance sheet reduction will be proceeding as planned, and the Fed says that they expect inflation to be around 5.2% at the 2022 year end, with core PCE being at 4.3% at the year end, while the Fed funds rate will be at 3.4% above the neutral rate. It seems ridiculous to me that they are projecting in the long term that they expect inflation to go down, but that is quite foolish, because even the Fed does not know what will happen in the next few months, and there could be expected events that affect this forecast and with uncertainty ahead. Also, what is interesting is that they're expecting lower headline inflation but higher core inflation next year. So that really signals that they are thinking we will see food and energy costs come down, betting that the Russia-Ukraine war will come to an end sooner, but that is rather out of their control. I suppose it is all about setting expectations so people do not freak out. But nobody knows what the Fed is going to do, and you cannot predict future cash flow with uncertainty. So I think for the time being, many people will continue to be owning hedges and long volatility, as long volatility is the only real hedge that has been working so far, and hence we will probably see elevated volatility for a while. The Fed was saying that the jobs gains have been robust in the recent months, while inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, broader price pressures. And the Fed said that they could see either 75 or 50 basis points in the next month, but 75 basis points is not going to be common in the future. So it seems like Powell is trying to avoid talking tough in order to avoid spooking markets. Powell is trying to say that the consumer remains strong, but the recent data does not suggest so. Consumer debt continues to pile at extreme highs in the face of high inflation, and even GDP estimates are projecting bad numbers. The Fed thinks that inflation will have a sharp decline into the next year and a year after due to front-loading of rate hikes, but this is quite ridiculous to say, as the Fed has no control over the energy policy, nor global supply chain, or the Ukraine war, and this is probably another policy error, and will probably result in a worsening of the situation. And with that being said, I want to thank you all for watching. Be sure to subscribe, and do check out the links in the descriptions for more updates. Thanks again.